but I don't see any limit to how far down the dollar can go against gold, and I don't see any limit as to how far down these other currencies can go against the dollar. I think those are two, durable trends, and boy, have these currencies gone down against the dollar a lot.
Now through Monday, April 7th, in honor of Silver Squeeze 2.0, for any Monster Box of Silver Eagles, we'll give you 2 additional Silver Eagles at no cost. And unlike some other Silver Squeeze deals, there's no limit. So if you purchase 1 Silver Eagle Monster Box, you get 502 Silver Eagles. If you purchase 10 Monster Boxes, you're getting a full tube of Eagles for no cost. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're glad to have this returning guest. Keith Weiner is the CEO of Monetary Metals. He joins us this Wednesday, April 2nd, 2025. Keith, thanks for coming back on Liberty and Finance.
Thanks for having me down again.
Our viewers appreciate the novelty of your perspective because you bring a rather unconventional viewpoint based on your studies of economics and monetary theory, etc., and often in counterpoint to what some of our other guests, the way that they look at things, and that's refreshing. Frankly, it's stimulating to be able to consider things from different angles, and we appreciate that. We wanted to get from you your outlook for gold for 2025. Our viewers are certainly excited about the performance of gold in the first quarter of this year and are interested, of course, in the fundamentals that are behind that and whether those are expected to persist through the remainder of the year and beyond. So any insights that you can offer from your research in that regards, and any other factors that people might not be watching yet but should be thinking about that you've been paying attention to along the way.
So first, two of those different perspectives that you said hopefully people will value. The first is that when the price goes up, as with any other price going up, number go up asset, you don't really profit from it unless you sell. So you're selling some of your gold for more of that fiat paper, which we all know is going down. Unless, of course, you're earning interest on monetary metals. Second perspective is that a rising gold price may feel good for your portfolio if you're overweight gold, but it kind of means bad things are happening in the broader society and the broader economy. And, I think a lot of gold people kind of imagine gold at $20,000 an ounce or whatever the number might be. And I think, okay, great, now I'm going to be one of the fat cats driving around in the Ferrari and so on. And that might afford you that Ferrari, but, you might find that society is burning down so badly that you would never dare appear in public in it because they'll destroy you in your car. Like think Caracas, Venezuela. Anybody with the money to have a Ferrari, either has an armed motorcade of militia or whatever guarding them, or else, they would hide that car away or get out of the country. And, we're nowhere near 20,000. Obviously, right now, we broke 3,100. I encourage everybody to think it's not that gold went up, it's the dollar went down. And the dollar broke below a very important round number, 10 milligrams. The price of the dollar, depending on where, I haven't looked at the market this morning, but depending on where it is right now, price of a dollar broke below 10 milligrams per dollar. To put this in perspective, when they created the Fed in 1913, price of a dollar it wasn't a price at that time. It was a contract, that was a deposit contract with a right of redemption. But the unit of a dollar was 1,500 milligrams. Now it's 10, under 10. So there are bad things going on in the economy. And of course, today is so-called Liberation Day, to which the only thing I could, we're going to add all these new taxes. Like, knock, knock, open up. I'm from the IRS and I'm here to liberate you. I don't know what else to say about that, but, bad things are happening and people are turning to gold, as a hedge against those bad things. I participated ever so slightly on the edges of what became a fairly contentious little debate on a private email list for Austrian school economists in finance. And this guy new to the list comes in, he's like, hey, I wanted to run this past Austrians. Why bother buying gold, blah, 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 blah. And it seemed like a pretty conventional Wall Street kind of approach. And various people offered various perspectives. And then he's like, yeah, as I thought, he kind of sneered, you know, you all are you know, believers in, you know, voodoo and witchcraft and whatever. And you know, you're just stuck on your favorite shiny rock or whatever, you know. It wasn't quite that pejorative, but it was pretty bad. And, you know, I thought about that. And, you know, first of all, we've done research and we have a white paper, The Case for Gold Yield in a Portfolio, you know, showing what gold in a portfolio does. And then if you add yield to it, how that changes the equation. And basically it's smaller drawdowns, lower volatility, better Sharpe ratio, which is exactly how the institutional guys are graded and compensated. That's how they earn their pay. Ultimately, it's a return, risk-adjusted return. But there's a whole other thing about gold, which is it's not a banking system liability. And do you remember when, I think it was 2012, the Cyprus banking system collapsed? And at that point, if you had euros in a Cyprus bank, you couldn't get them. They were letting you get 600 a day or something like that. And unemployment on the island hit, I don't know, 40% or something like that. So, and if you're on the island and, you know, you want to have work to support yourself, you had to get to the mainland where there was still a functioning economy. If you had euros in the Cyprus bank, forget it. If you had gold, you just walk down to the harbor. Anybody would have been happy to take gold to transport you to the mainland and then, you know, get a job there. And anyways, I wrote about this at the time, and I said, you know, it's not about whether the price of gold went up in euro terms, which it didn't. It was flat during all through that incident and you know, even after. It wasn't that you were betting the price was going to go up. It's that it was money good. And suddenly the euro wasn't. Or at least Cyprus euros weren't. And so people are turning to gold now, you know, with each little crisis. You know, call it the crash of 2001 and the response. And I think part of that was the fallout of long-term capital management and Gordon Brown's bottom. We sold half the UK's gold. There was a bunch of things occurring pretty close to all of that, you know, together. That brought a bunch of people to gold that had never been gold owners or buyers before. And of course, that represented the bottom of the price trend that had been falling roughly since 1980. Then in 2008, a lot more people came to gold, including myself. Before that, I didn't really think about it too much. I didn't have the money anyway. I was building a company. You know, COVID and the response to COVID was insane. More people coming. And now I think between tariffs, trade wars, you know, there's a lot of ugly stuff going on in the world, and people are turning to gold. You know, for what I would call better reasons. 2009 to 2011, a lot of people were buying gold on the belief that quantitative easing was going to cause imminent hyperinflation. And I remember saying at the time and writing about this, that this isn't true. This is not a good reason to be buying it. And if these people all turn around and sell because their prediction doesn't come true, you know, it's not going to end well. And of course, that's exactly what happened. But I note that post the high of 2011, the ultimate low was, I think it was 1040 something. The old ceiling, you know, the pre-2008 ceiling had become the post-2011 floor. You know, just over $1,000, and obviously we haven't looked back. Now, anyway, so people were buying out of fear of imminent hyperinflation. Today, I don't think that's the fear. I think the fear is, you know, what if essentially the dollar's a credit, right? So what if the credit isn't good? Either because the U.S. government plays a game and says, well, people from your country aren't entitled to get at their dollars, or what if you have another banking episode like Silicon Valley Bank, or I might add Credit Suisse occurred, you know, a little bit after that, as I recall. I mean, you know, it's like sudden death syndrome, you know, where the regulators, so Silicon Valley Bank was seized by the regulators on a Friday, as I recall. The Wednesday, 2 days prior to that, the state banking regulators, these are the alleged experts in the room, allegedly charged with allegedly protecting the interest of the little guy, declared, the bank was perfectly healthy. It was fine. 2 days later, completely insolvent, unable to meet, liabilities when presented. So people are buying gold to just be out of that. There's geopolitical reasons. One thing that tariffs is going to do, which will be very perverse, it's going to make it harder for foreign dollar debtors, right? So everybody around the world borrows dollars, especially international kind of business. And they all owe dollars. They're in debt up to their eyeballs. Well, now if you can't export stuff to the U.S., it makes it harder to get dollars, which means they're going to be more desperate to get dollars, in other ways. If you can't get in trade, you have to, you have to sell your goods somewhere else for some other currency and dump that other currency to trade it for dollars. You can end up seeing the dollar, rallying against all these other currencies, i.e. all the other currencies falling. So with all this stuff going on, people are buying not largely retail stackers in the U.S. and Canada and the Western world. That's not where the buying is going on. But in, some institutions are buying now, I can tell you that. And in the rest of the world, we have clients that are jewelry stores in the Middle East, for example. Now, jewelry, here in the West, it's about art. The pieces are very fine. There's not a lot of gold weight to, a piece of jewelry from Tiffany or whatever. But in the Middle East, a large amount of that jewelry, the whole purpose is to have a weight of gold. They fashion it to an attractive shape, or what appeals to the aesthetic of that culture, but it's really about just having a big chunk. I picked up a necklace that was like 3 ounces. I mean, it would be like Frodo wearing the ring. It's like you should be cutting it to your neck by the end of the day. But anyways, it's basically money is what they're using it for. They hold it as a store of value. But anyway, so they just the Middle East, they just finished their Ramadan holiday, and I don't know if they do a lot of buying during most of Ramadan, but they do a lot of buying, I think, at the end of Eid or Eid. I don't know how you say it. From what we see, sales were very robust this year. And there was some concern in that sector with the gold price up as high as it is. Would people scoff at buying? Who wants to be the idiot who buys at the top? But there was robust buying, which probably indicates it's not at the top. So, if you want my call, so we just put out our Gold Market Outlook Report 2025. I don't want to give away the numbers. I don't want to give away the punchline. I want people to download it. But, I will say that we're in a bull market. We are not in the endless dark days of, post 2011 through 2018, where every time it blipped, all the gold bug analysts, all the usual suspects came out and said, it's going to the moon, it's a rocket ship. Never turned out to be true. And we could see it in the data. We follow the gold basis, so we could see that in the data turned bearish the moment the price would blip. And so that was a sell the blips market. I now think we are in a buy the dips, not a sell the blips, market. And then, do you get that dip? Well, we'll see. So at the time I was writing it, I have to finish it, and I turn it over to our marketing team. I put in infographics and all kinds of other stuff, and it takes a little while. So there's a risk I'm sticking my neck out that either by the time it comes out, I look like an idiot, or it looks like I didn't make much of a prediction because what I said already came true, which is kind of what happened last year. But I said, I think a correction is probably due. And at the time I wrote it and turned in my essay, the price had dropped a little bit to just under $3,000 at $29.58 or something like that. It's like, well, this could be the start of the correction. Time will tell. I don't have any more time to wait for, submitting this for publication. And it turned out that was really not much of a correction, at that time. I do think a correction is likely. Nothing goes in a straight line. But I think, the fundamentals, broadly, the macro fundamentals are very bullish. That said, but what you call the micro fundamentals, when we follow the basis, so we see that, rising price, what's happening is the basis rising. That's not good. It's the basis falling. Well, that's good for price, but maybe not good for the world. In recent weeks, a rising price has had a rising basis. So that means that there's more and more of this price action is being driven by futures, by people buying futures with leverage. And the reason why that's bearish is because by nature and, almost by definition, people who use leverage in the futures market are short-term. They're going to turn around and dump it, either because they got their price target and they take their profits, or because it went the other way and they can't bear the losses and they have to stop. So that's brewing. I would think it's likely to be a correction, but I think this is a buy the dips market.
When you mentioned these macro trends that are happening, and it's not the U.S. retail buyer, it's foreign demand. You mentioned primarily retail demand. What about central bank demand internationally?
Yeah, so there are certain central banks that are buying. There are other central banks that are rumored to be buying, but that don't necessarily talk about what they're doing. It's widely believed in the Middle East that the government of Iran is buying, or Central Bank of Iran. I'm not exactly sure their exact structure. It's widely believed the Saudi central bank is buying. I don't know if there's been a lot of news about that. So yes, that's happening. I don't think the central banks are buying enough quantity to really, move the price by hundreds and hundreds of dollars and keep it moving. I think rather it can be a psychological thing. If everyone sees that certain central banks are buying, it kind of gives them cover to buy, or a reason, or, a theory, a thesis, right? Oh, central banks are buying. They must know something we don't. Now, I have to chuckle at that. I've met a number of central bankers, both here in the U.S. and globally. Not the top guys. I've never met a Jay Powell or Ben Bernanke, but I've met people at one level down. And if you think that these people know something we don't, I got to tell you, they are utterly conventional. They're basically bureaucrats and, operators. They've learned that, you're supposed to push this lever in response to this, thing. And, at best, and they're politicians, and they promise, the elected officials what the elected officials want to hear. And, in exchange for, almost inconceivable levels of power. Which anyway, you're talking about Lord of the Rings. There's a whole story about the theme of power and how it corrupts. But no, I don't think they know anything we don't. But a lot of people say, oh, the central bank's buying. They must be planning something, and they must know something, and so they buy. So psychologically, that turns it on. But the quantities the central banks are buying just, aren't enough to. I don't think really moves the needle very much.
You mentioned a little while ago in this discussion that rather than fixating on the price as the primary phenomenon, you're saying it's reflected. It's actually a symptom of the destruction of the value of the fiat currencies. And you talked back to the time when the U.S. dollar was convertible into gold. In fact, the currencies of the world at that time were by and large convertible into gold. They were just different ways of handling gold. Do you see that in the future, near term or midterm, with the BRICS plus collaboration of countries trying to find a settlement currency outside the dollar and the SWIFT system, et cetera? Do you see a coalition forming around relying on gold as the actual foundation of the monetary base for any countries or groups of countries?
So it's one of those complicated issues. There's a lot to tease apart out of this. The first is there a desire to have something that isn't the dollar amongst those governments in that part of the world? Absolutely. No question. They would all love it. But I have a friend who says people in hell want ice cream doesn't mean they get it. So, the world is wired in a certain way. It's a dollar world. And all the other paper currencies are, first of all, dollar derivatives. They're almost like, there used to be company towns like in the coal mining districts in Western Virginia. The other currencies are almost like, coal mining company script by comparison. Something like 99% of all derivatives contracts out there has a dollar on at least one side. I mean, it's not like, oh, the dollar competes against these other things. It's more like the dollar's the aircraft carrier, and all the other currencies are various kinds of rowboats, inner tubes, a floating log that's, strung together with, another piece of floating pallet, a little kayak, all of them together don't add up to enough mass to scratch the paint on the side of the ship, which would run them down without even, thinking about it. So, what are they going to do and how are they going to do it? It's not a matter of buying gold. A bank does not buy money. A bank is to seek deposits. If you want a gold redeemable currency, the only way that works, you can't retroactively declare it to be gold redeemable. That will be a price fixing scheme, and then people will call you on it and you'll run out of gold and have no credibility and have to abandon it or change the price or whatever. You have to attract deposits. But, if I can plug monetary metals, that's what we're doing. Is, one customer at a time, 1 ounce at a time, you're giving people a reason to deposit that metal with the promise of redeemability is a big part of it. Nobody would give you their gold if you said, I'll never give it back to you. Or you don't have any credibility in your promise to give it back. Or there's no regime of rule of law, to give it back. So they have these really big structural issues. Not to mention, most of these countries have capital controls, right? South Africa, India, China, Russia. So I posted on Twitter once and I said, Brazil's the only one that doesn't have capital controls. And this Brazilian said, hey, I really respect what you're saying, but certainly other countries is true. And what you said about Brazil is true if you're a retail guy and you want to withdraw a few $100s. If you're a major corporation and you want to withdraw millions of dollars, there effectively are capital controls and you need permission from the central bank. So Brazil also has capital controls for larger and institutional amounts. So you've got these countries that are imposing these horrible monetary regimes on their people to control them and loot them. Let's call a spade a spade. It's a looter scheme, right? It's how you steal from the people. They might love the idea of gold, if you make it work for settlement in some way. But they don't actually want to have an actual gold standard because the gold standard is the money of a free market. And that's the last thing anybody wants. I can go on and on. Who actually wants a gold standard? Well, if you look at the sound money movement, so-called, even in the United States, most of the economists in the sound money movement would define sound money as a fiat currency where the consumer price index is neither moving up nor down. And so I wrote an article about that saying sound money isn't what you think it is. And I took that picture from the Saturday Evening Post. Norman Rockwell had this painting, was called The Double Ride. And the woman is buying a chicken at the butcher. And, so she's pushing up on it, but the butcher paper is blocking his view, so he can't see it. Meanwhile, he's pushing on his thumb down on it, but the meat is blocking her eyes from seeing it. And I said, suppose that both of those forces manage to counterbalance each other perfectly. Would you call that a sound measure of the weight of the chicken? No, of course not. They're both cheating. And even if the two cheats happen to cancel in that one instance, that doesn't mean. So, industry is always becoming more efficient. That's, I guess, this. A dollar is being debased, that's this. And if those happen to cancel each other 1 year and CPI is 0, that's not sound money. There's very little intellectual support. And now I'm saying even in the libertarian end of the spectrum for an actual unadulterated gold standard, which has no government involvement in money, no free market. There's almost no, that's the fringe of the fringe of the fringe, even in, even in the West. So what are they really going to do? Well, they mess around and they try to use each other's currencies, various ways, but it doesn't really work. The Russian finance minister blurted out, this is a couple of years old now, we're not accepting Indian rupees anymore. We have a pile of useless rupees. Something useless, which is true because there's capital controls. There is literally no market for rupees outside of India. So what are you going to do with those rupees? It's not like the dollar. So would they like to use gold in settlement? Would they certainly like something that the U.S. government couldn't just say, oh, well, we're going to shut off your money, as the U.S. government did to Russia? Yeah, of course they'd love that. But how are you going to get there? And, I guess there's a saying in management circles, everybody says they like change, but nobody wants to be changed. Or the other one, in more religious circles, everybody wants to go to heaven, but nobody wants to die to get there. You sort of have this dilemma of, okay, what are you really willing to do to get to gold? And, it's very political. It's very charged. They all have their own internal politics. You look at American politics and how intractable it's become. Well, every country has their own intractable internals. They're just different from, the U.S. and not nearly as well written about because they don't have free presses. That's the other problem in these places. So, it is what it is. Are they going to move to gold anytime soon? I wouldn't bet on it.
So back to the macro picture, then you mentioned anticipating a likelihood of a significant pullback or correction as part of something that happens normally during bull markets. But can you give us a understanding? I don't know, you can use a metaphor if you want of innings of a baseball game or something, as far as, do you see this as a longer term bull market within which there will be corrections, but as you said, by the dip opportunities within an overall trend? And again, what we're looking at is the inverse of the destruction of fiat currencies, really.
So I don't know necessarily how significant the correction would be. I mean, it could be $100, 3 days, and then you're back to the race. Or, it could be $500. The gold price has moved up quite a lot over the last year and a quarter. I think we ended 2023 at just under $2,000. It's moved a lot, right? So could there be $500 correction or some Fibonacci level or something like that? Yeah, it could. That wouldn't surprise me. But on the other hand, I wouldn't necessarily predict it because I think the buying pressures are ferocious, for all these reasons we're talking about and many more. Another one that needs to be said, many of these other countries, certainly India, Russia, Brazil, Turkey, the currency is the toilet paper. And they're always going down. I mean, I've seen things in India, and then now measuring it against the dollar as if the dollar was a stable reference point. I love the analogy of you're at the top of the cliff and you have a couple of GoPro cameras and a bunch of construction materials. So you tape a GoPro camera to a brick, you tape another GoPro camera to a piece of plywood, you chuck them both over the edge. From the camera on the brick, the plywood is going up, right? So there's more air resistance, it's not going to fall as fast. So, in India, the rupee goes down against the dollar. It's at 11% a year, 8% a year, something like that. And then you can say, well, the gold, if dollar goes down against gold at a certain, certain rate, as well, depending on what period you use for measurement, and it gives you kind of a sense of it. Those people are buying gold simply to protect themselves because from, the obvious, very visible and very, very significant ravages of currency destruction. Everybody in Turkey's not a small country by population. And everybody in Turkey, if they have any wealth at all, would have at least 10 grams of gold, third of an ounce. The average person, I'm told, would have a lot more than that. India, the numbers may be lower because they're so much poorer. The average income in India is one of the lowest. But again, a strong gold affinity because they never, government issued currency is not for savings. It's not like the dollar where we Americans look at it and say, yeah, I've got $1 million in my IRA or whatever. They just don't even think of it that way in these countries. And you can't because the currency is going down so fast. So all this buying, I think this is durable. We'll see where it goes, but I don't see any limit to how far down the dollar can go against gold. And I don't see any limit as to how far down these other currencies can go against the dollar. I think those are two, durable trends. And boy, if these currencies gone down against the dollar a lot, in the last several years.
You mentioned, in addition to this inexorable and obvious ravaging of the currency by debasement, you also mentioned systemic banking risk with the example of Cyprus, and there have been others. You mentioned Silicon Valley Bank in passing, but as far as capital controls, giving the government an opportunity to loot from the people, it's rather interesting because our viewers are quite concerned about the potential for central bank digital currencies or something where you just can't get out of the system. All of your ability to exist and to be a transactional member of the economy requires you to be 100% inside the system, and you can't get your value out. And therefore you're basically caught in the pen and subject to whatever well, in the case of inflationary pressures, it can be artificially claimed capital gains that you're quote unquote enjoying. So they keep taking a cut every year when you do your taxes. If you sold anything for a higher nominal price than you bought it for, because they've destroyed the currency in between times, even though you're just trying to keep the same asset, that kind of thing, or just loss of purchasing power of your earnings, your savings, your retirement. Aren't we when we've also had some fairly large-sized clients at Miles Franklin approaching us to buy tens of millions of dollars worth of metal, and their bankers giving them a very difficult time to sending that cash out the door from the bank. Multiple bank presidents and so on, meeting with them for hours in a closed room, trying to tell them that they shouldn't do this and all that. So what about capital controls and systemic risk that ordinary depositors and banks may or may not be realizing that they're subject to, and what gold can do for them?
I mean, I agree with everything you said, and that has to be a factor. There are many, but I think that has to be a factor to why people, turn to gold. I have to give my little rant about, banks becoming more and more difficult just to get access to your own money, and I don't think it's actually the banks choosing this of their free will. Sometime back, it must have been in the 1950s or 1960s, some crook got caught, and then somebody in the angry mob said, yeah, why did their bank let them do that? Yeah, why did the bank let them? Let being the concept here. And that led to the Orwellian named Bank Secrecy Act, which I think was created in 1973. Yeah, I plus or minus a few years. And that gave banks an onus that I'm sure they didn't want at the time. Although now all this regulation serves the biggest cronies always benefit, because the cost of compliance per unit is much smaller for JP Morgan than it is for your regional savings alone down on the corner street. But it gave them the onus to, number one, be deputized by the government to police for crime. Number two, at their own expense. Right, so the government doesn't give them a subsidy for that; they just have to do it. Number three, by crime, what we mean is pre-crime. They have to look for people that haven't necessarily done anything yet, but you could be doing something. We just don't know. So how are we going to prove that you're not gonna? And then number four, their own liability. If it turns out you actually do commit a crime, the regulators can come and smash the banks with billion-dollar fines and all kinds of stuff, ruin careers of bank executives. Now, every so often, whenever there's public sentiment for it, they ratchet up the scope, the depth, the intensity, the compliance enforcement. They ratchet all that up every once in a while. And it was actually in 2017, the Trump first administration, that ratcheted it up very heavily. In fall of 2017, massive account closures of, precious metals companies, gun companies, gentlemen's clubs, all kinds of things, anything that wasn't really deemed to be politically acceptable. The banks were closing their accounts and all that. And now it's gotten to the point. So what banks are obligated to do is something called anti-money laundering, AML, and KYC, know your customer. That's now morphing into know your transaction. So it's not enough to say, okay, let me see your ID, Mr. Kaiser. Okay, I know it's you. We've already done the proof that, okay, you have salary, and here's your employer, and here's the amount you're making, and here's how much you inherited from your grandfather. We've already done all that. We've already taken the proctoscope and done all that. Now we want to look at the transaction. Okay, so you're paying this guy, Mr. Wiener, $1 million. Where did you get the $1 million? Let's see that transaction. Let's see the invoice of, why is this party paying? Who is it? Where did they get the money? Why are they paying it to you? And now, what's the invoice from Mr. Wiener? Why are you paying him? And who is he? And let's do some AML on him. And so just, it's an endless ravel. It doesn't ever bottom. You can go deeper and deeper and deeper and deeper until the whole thing seizes up. And I don't think the banks particularly want this, but this is how you stay legal. And if you don't, they're going to shut you down. So, the banks are all looking for a safe harbor. They all want to show the regulators they're doing whatever the required thing is that they can't be, And so the thing with gold is, for all the reasons you said, it's private, it's off-grid. Nobody really knows, if that stack of gold coins you had, really did fall into the lake in a tragic boating accident or not. Or whether, you paid your next door neighbor for, child trafficking and narcotics. They can't really prove that. They can't really do AML or KYC or KYT, know your transaction on anything you do with gold. So they don't like it. The banks just becoming more and more nosy. That is definitely, part of the backdrop. And in a certain sense, it's not capital controls as a monetary policy, right? It's, China doesn't allow the citizens to trade their yuan for dollars, because if they did, there'd be billions of Chinese, dumping all the yuan for dollars, and the yuan would crash. This isn't that. This is just a general, we'd like a little more control over the lives of the little people. And next year, we'd like a little more control. And the year after that, we'd like it even a little bit more, without end. And, the frogs in the water, every year we turn up the knob one click, just to see if the frog's ever going to jump, or, just out of curiosity. It's a science experiment, right?
So that was part one of the question is, are we actually living in a world of increasing surveillance and capital controls, Orwellian, as you said, and it sounds like, that's the direction. What about the systemic risk that people may be needing to be aware of?
No, I was going to say, it does have to be said that even without a central bank digital currency, they already have all of those, tap, like if this is like a wire, they already have all those points where they can tap it anyway, because of the credit card companies, let alone Apple Pay or Google Pay or whatever. Almost everything is done through the banking system, and they already have, the ability to see down to every transaction in real time, and they already have the ability to order a bank and say, don't allow Mr. Kaiser to send a wire, or don't allow him to send a wire to Mr. Wiener. They already have all that anyway. They don't need a CBDC for that. But what a CBDC does is that when interest rates go back to being negative, then there's no way to opt out. Right? If you have paper cash, there's no positive yield on paper cash, but there's no negative yield on paper cash also. So when a bank account is taking away 1% a year or 2% a year, there's going to be a tendency for people to want to pull the cash out. So they're like, okay, we're moving to a CBDC, no more paper cash for you. And the CBDC will be programmed to have the same rate that it's draining value away as the banks do. So, you can't, it's illegal or it's impossible for the frog to jump out of the pot. As we're jumping out of the pot, there's actually another pot with the same water and the same temperature lined up for him to jump into when he jumps out of that one.
And what about stability? You mentioned Silicon Valley Bank as being one of those moments. You were listing a whole bunch of moments that increased interest in physical gold ownership, and one of them related to banking risk, and you mentioned Credit Suisse as well. Where do you see banking risk in our current scenario and going forward?
I guess there's sort of the shorter term view that would say, well, they fixed it because the Fed announced a lending program. So the problem with Silicon Valley Bank was, at the height of 2020 monetary madness, the 10-year treasury was down to a yield of 0.65% or 63%, something like that. And which means the price of the 10-year treasury had record highs. And so just at that same moment, so Silicon Valley Bank's an unusual bank for its flows in that when venture-backed, so their clients are only venture-backed companies, basically. They don't have like retail, employees don't have accounts at Silicon Valley Bank. But if you work at Silicon Valley, your employer might. So when the venture capital is flowing freely, they get massive inrush of deposits, which they did. They have to turn around and buy an asset at the all-time high for asset prices, and the assets that banks buy, they don't buy houses, they buy bonds. So they bought all these treasury bonds, which don't have any default risk in nominal terms. Banks should be fine, but they bought long-dated treasury bonds. Then, fast forward, 2 years later, a year and a half later, and, Jay Powell says we're hiking the interest rate. And, the interest rate went up so that the bond price and the interest rate are a seesaw, a strict mathematical inverse. So you're pushing interest rates up, bond price going down. The price of a 10-year treasury fell like 22%. So suddenly you have the liability is still $1, but now the asset is 78 cents. It's got a big problem. Now, the fix for 2009, I say fix, every time I use the word fix in these contexts, it should be scare quotes because nothing's really getting fixed. The fix for 2009 was FASB, the Financial Accounting Standards Board, said we're going to change the rules. Formerly, if your asset is impaired, you have to mark it to market. That has been, the law of assets since Luca Pacioli first proposed double entry accounting in the Renaissance 500 years ago. Okay, but we're going to change that now because we know better than 500 years of economic and accounting history and say, if you declare that your asset is to be held to maturity, you don't have to bother marking it to market anymore. So that was almost to the day that the stock market found a bottom because the accounting suddenly looked a lot better and it was off to the races again as of March or April 2009 when they did that. Okay, fine. So if you have a treasury bond and the value is impaired, no big deal. So that was Selfwood Valley's position. The problem is it is a big deal because if you have withdrawals, you have to sell an asset of some sort or another, unless you scrupulously match the maturity of your assets to your liabilities, which they don't do. You have to sell an asset, and now suddenly the price you're going to get for that asset is 22% lower than it had been. So the nature of Silicon Valley's bank is that when VC money is flowing freely, deposits are increasing. When the VC shuts off, which it did due to higher interest rates, then all these companies are bleeding cash, so the money is going out. So it's not even a run on the bank like on purpose. It's just the nature of the flows of Silicon Valley Bank. It's a boom and bust, cycle. But now, unlike the previous times when the money was flowing out, you couldn't sell that asset anymore for anywhere near its price. So, they're insolvent. And at that point, somebody, several clever people, including a couple of venture capitalists, noticed this, and they told their portfolio companies, pull all your money immediately, which only accelerates the run, right? And so there you are. Now, there's a couple of problems with this. One, this suspension of mark-to-market rules makes the banks less sound, but it makes them more opaque. It's harder to tell their soundness anymore. Every time there's a signal, it's almost like they have an inspector that's running around the house looking for signals in order to tamp them down or duct tape over them or put some cloth so you can't see it. It looks like it's fine. It doesn't actually fix anything, but it makes it look better. The second problem is that, there were dreadful losses. And of course, these companies had very large deposits, much greater than $250,000, which is the limit of FDIC. So the regulator seized Silicon Valley Bank on Friday, and they said, everybody will have up to $250,000 FDIC funds available. We'll tell you what the new account is or whatever by Monday morning. Everything over $250,000, we're going to have to see how the liquidation goes, and you'll get what you get. By Sunday, they said, oh, by the way, we seized another bank. Is that Signature Bank? I don't remember the name of the other bank. And oh, by the way, we're going to honor accounts of whatever size with no limit. So you got a couple of things going on there. One is, do we have the rule of law, or can, the Treasury Secretary or FDIC or whoever just dictate these things? And number two, if this happens to your bank in the future, can you count on that? Is that really like a legal precedent? Does that have the effect of law? Well, not really. The limit is still $250,000. You can't really rely on that. But what by them doing that, what they were admitting was, this is so bad that if we actually allow these companies to suffer these losses, then that is going to cause a crisis. And so we're going to just override the rule of law with the rule of men just to avert this one crisis, just this one time. Trust me, I'm just going to put on the ring just for this one thing, which I know to be really, really important. Other than that, I'm going to put it back in the vaults only to be used at the utmost end of need. And there's no credibility to that. So when are they going to use it again? When will they not use it again? And it becomes very political. Silicon Valley Bank was perceived to be liberal, right? The executives are talking about DEI and things like that. So the Biden administration, Janet Yellen as then Treasury Secretary, were favorably inclined to help them out. If Trump had been in power, Silicon Valley Bank might have been dumped, on its ear. The way Lehman Brothers was, no bailout for you because you lean liberal. We only bail out conservatives. Like, if this starts to happen, obviously the logical response of the people is to be very afraid of all this. And of course, if you buy gold, you're opting out of any of this nonsense. So gold becomes relatively more attractive. Finally, I think interest rates are going to come down with a vengeance. And the interest rate is the opportunity cost for holding gold, because if you hold gold, other than with monetary metals, there's no interest on it. But if you hold, let's say a treasury, you get paid whatever the interest rate is. But if they lower the interest rate to zero, there's no more opportunity cost. So, gold, because anyways, I just think it's almost like one of those rare moments when, Mercury, Venus, Earth, Mars, Jupiter, Saturn, everything's all lined up. And, how often does that happen? I think it's the perfect storm. For this year, for sure. And probably a lot longer than that. Again, with corrections along the way, but I think bull market, absolutely.
Keith, you mentioned in passing at the beginning, and I don't want to lose track of this, a white paper report about gold in a portfolio, how it stabilized the portfolio, and also a gold market outlook report 2025. Okay, so folks, look in the description of this video. We'll put links to those two, the white paper and the gold market outlook report for 2025 from Monetary Metals. Keith Weiner, just grateful for your presence here on Liberty and Finance. And once again, I found it a stimulating discussion. I'm confident that our viewers and subscribers will as well. And folks, only half of our viewers are subscribers. So if you're not a subscriber, it doesn't cost you anything. Just click the subscribe button there where you watch us and you'll be a subscriber. But you can also get on our free mailing list. It's completely private. We don't share your email address with anyone. If you go to our website, libertyandfinance.com, within your email address, click submit at libertyandfinance.com. Make sure you confirm on the confirming email. You'll get one email per day in your inbox with our latest guests, including all of Keith's appearances here on Liberty and Finance and any weekly specials. So once again, Keith Weiner, CEO of Monetary Metals, thank you for joining us on Liberty and Finance.
Thank you.
Now through Monday, April 7th, in honor of Silver Squeeze 2.0, for any monster box of Silver Eagles, we'll give you 2 additional Silver Eagles at no cost. And unlike some other Silver Squeeze deals, there's no limit. So if you purchase 1 Silver Eagle monster box, you get 502 Silver Eagles. If you purchase 10 monster boxes, you're getting a full tube of Eagles for no cost. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.